Welcome back to Tesla Daily News Podcast. Today is April 28th, 2026. In the next few minutes, we're breaking down the Tesla stories that matter most for Tesla: autonomy timelines, hardware risks, Elon's equity moves, and a few under-the-radar operational and demand signals. Let's start with the biggest autonomy headline, and it's a mixed one. Story 1. Tesla just drew a hard line on older full self-driving hardware, and some owners feel blindsided. Context. For years, Tesla's valuation has leaned heavily on the promise that software, especially self-driving, can expand margins and unlock high recurring revenue. But that only works if the installed fleet can actually run the software. Details. Multiple reports quote Elon Musk saying that Tesla's shipped before 2023 cars running Hardware 3 will not be able to achieve fully unsupervised full self-driving. Musk said Hardware 3 simply does not have the capability for unsupervised FSD. Tesla's proposed remedies are either a discounted trade-in or a physical retrofit, computer and cameras, performed at microfactories in major cities. Meanwhile, there's also reporting that the Netherlands approved Tesla's supervised full self-driving system, but that rollout excluded Hardware 3 vehicles, adding fuel to European owner frustration. Impact. For investors, this is less about a few angry customers and more about unit economics and legal risk. If Tesla has to subsidize large-scale retrofits, that's margin pressure. If it pushes trade-ins instead, it could become a demand lever, but at the cost of discounting. And if regulators approve supervised, but not unsupervised, that delays the higher-margin Robotaxi revenue narrative. There's also litigation risk. Owners who paid thousands for FSD may argue marketing implied future capability, which could translate to settlements, refunds, or reputational drag. Takeaway. Watch for Tesla to quantify how many Hardware 3 vehicles are in scope, what the retrofit costs per unit look like, and whether Tesla recognizes any new FSD-related liabilities or offers broader credits. Story 2. Robotaxi competition is accelerating, especially from China, and cost curves are getting uncomfortable. Context. Tesla's bull case increasingly rests on autonomy and fleet economics. But Robotaxi is not a winner-take-all market if competitors can deploy at commercially viable costs. Details. Chinese robotaxi company Pony AI said the total cost of its 7th-generation robotaxi, base vehicle, battery, and autonomous kit has fallen below about $33,700, explicitly claiming it's cheaper than a basic Tesla Model 3. WeRide announced a plan to put around 200,000 autonomous vehicles on roads globally over the next 5 years through a deeper partnership with Lenovo, and said its newest computing platform could cut autonomous system costs by 50%. Both companies are targeting thousands of Robotaxis by the end of 2026. Impact. The investor implication is straightforward. If competitors can deliver Level 4 Robotaxi hardware cheaper than a consumer Model 3, then Tesla's autonomy advantage needs to come from software performance, safety, regulatory approvals, and operational scale, not just vertical integration. Lower competitor costs also pressure any future Robotaxi pricing power and could compress margins in a world where rides per mile becomes a competitive commodity. Takeaway. Tesla investors should track not just Tesla's Robotaxi launch dates, but real-world cost per vehicle and cost per mile versus Chinese and US rivals, and the pace of international regulatory approvals. Story 3. Tesla is rolling out a virtual queue for superchargers. Small feature, big strategic signal. Context. Charging convenience is one of Tesla's strongest moats. But that moat gets tested when stations are congested, especially now that Tesla has opened parts of the Supercharger network to other EV brands. Details. Reports say Tesla has started rolling out a virtual queue system through the Tesla app and in-car prompts. When a driver arrives at a busy supercharger, the system can show wait times and place the driver in a queue, with the app showing position and how many cars are ahead. The system appears designed to reduce disputes over line cutting, an issue that's reportedly been increasing at busy locations. Impact. This is operational leverage. If Tesla can increase throughput and reduce charger social friction, that helps utilization and customer satisfaction, and it supports Tesla's ability to monetize charging without needing perfectly timed physical expansion. It also matters for brand protection. Charging conflicts are the kind of viral negative story that undermines Tesla's premium perception. Takeaway. If Tesla's queue system expands to non-Tesla drivers, that becomes a meaningful product advantage for supercharger-hosted charging, potentially a lever for higher uptime, higher revenue per stall, and stronger network loyalty. Story 4. Elon Musk is moving closer to monetizing Tesla's long-delayed compensation. Over 300 million shares are being registered. Context. Executive compensation and share supply matter for Tesla because they influence dilution, governance sentiment, and headline-driven volatility. Details. Multiple outlets report Tesla filed to register roughly 304 million shares tied to Musk's 2018 pay package after litigation delays. At recent prices, some reports put the value north of $110 billion. Tesla said Musk entered an implementation agreement tied to the package. Impact: registration itself doesn't automatically mean immediate selling, but markets often read it as shares are now liquid, which can pressure the stock short-term on fears of supply. The bigger investor question is governance. Even if the pay plan is legally cleared, this keeps Tesla in the spotlight for executive compensation size and board oversight, issues that can influence institutional holders and proxy advisors. Takeaway: watch upcoming filings for any selling plans, loans against shares, or 10b5-1 style arrangements. And keep an eye on how this intersects with Tesla's capital allocation, because if the company ever needs to raise funds for AI compute, factories, or robotics, investor tolerance matters. Story 5. Germany's Gigafactory Berlin employee policy is drawing scrutiny, even as Tesla touts a sharply lower sick rate. Context: production stability affects margins, delivery cadence, and operating leverage. But labor relations and legal exposure can become a chronic distraction, especially in Europe. Details: reporting out of Germany says Tesla's Grünheide plant reduced its sick rate to under 5% from much higher levels previously discussed publicly. The factory leadership credits incentives like an employee stock program and on-site amenities. But the same reporting says Tesla has sent letters to some employees indicating no further wage continuation for what Tesla argues may be a continuation of prior illness, and requests that employees provide proof of a new illness and, in some cases, release doctors from confidentiality. Labor law experts quoted in reports argue the approach may go beyond what courts require. Impact: for investors, there are two sides. If Tesla reduces absenteeism sustainably, that can improve throughput and unit costs. But if the methods lead to legal challenges, union pressure, or reputational damage in a politically sensitive market, Tesla could face higher HR costs, fines, or productivity disruptions. Takeaway: monitor for regulatory or court actions in Germany, and for any commentary in Tesla's next filings about labor-related provisions or contingent liabilities. Story 6. BYD's scale keeps framing the competitive reality, and it matters for Tesla's growth multiple. Context: Tesla's stock multiple depends on Tesla being seen as more than an automaker. But the automaker part still funds everything. Details: a widely circulated profile on BYD's founder highlights BYD's approximate 4.27 million EV sales in 2024, underscoring the gap in volume versus Tesla and BYD's ability to push costs down through vertical integration. Impact: when a competitor is selling multiples of your volume, it can influence global pricing, supply chain bargaining power, and the narrative around who wins mass-market EV adoption. For Tesla, that increases the importance of differentiation, software, autonomy, charging, energy storage, and robotics, because competing purely on vehicle price gets harder. Takeaway: Tesla's next big investor debate is whether autonomy and robotics scale fast enough to offset slower vehicle growth in a market where BYD and other Chinese firms can flood segments with lower-priced offerings. Before we wrap, a quick market-wide note that still matters for Tesla. This week is packed with major central bank decisions and heavy big tech earnings, and oil prices remain sensitive to Middle East supply disruption headlines. Higher energy prices can shift consumer sentiment and rates expectations, which feed directly into auto affordability and EV demand. All right, let's close it out. Today's core Tesla themes are: 1. FSD hardware segmentation is now a real financial and legal issue, not just a technical footnote. 2. Robotaxi competition, especially from China, is moving faster on cost than many investors expected. And 3. Tesla is improving operational tooling and factory metrics, but governance and labor stories can still move sentiment. For tomorrow, watch for any additional details on hardware 3 retrofit plans and pricing, more data points on the Netherlands and broader EU path for supervised FSD, and any follow-on SEC filings or headlines tied to Musk's newly registered shares. If you found this useful, subscribe to Tesla Daily News Podcast and follow us for your daily, investor-focused Tesla Roundup.